In the span of about a week, three of the world's largest economies each put out a number that came in worse than expected. Japan's currency sank to its weakest level in roughly 4 decades. The United States posted GDP growth well below what economists were forecasting, and the Eurozone's own business activity data came in soft enough to miss expectations for a second straight month. Individually, each one of these looks like a local story you could scroll past. Together, there's something else entirely. If you own gold or silver, or if you're just trying to understand why these metals have been moving the way they have this week, I need you to give me the next few minutes, because these three stories aren't separate. They're the same underlying tension showing up in 3 different countries in the same short window, and understanding why that happened matters more than reacting to any single headline on its own. By the end of this video, you'll understand what actually happened in Japan, the US, and Europe, why it's connected, and what it means for the metals sitting in your safe or your portfolio. Stay with me, because the connection here is the part almost nobody is laying out clearly. Section 1. Japan, a currency at a 4-decade low. Let's start with Japan because it's the most visually dramatic of the three. The Bank of Japan held its interest rate steady at its latest meeting, and in the aftermath, the yen weakened to its lowest level against the dollar in roughly 40 years. That's not a small country with a shaky economy. Japan is the world's 4th largest economy, and its currency just touched levels not seen since the 1980s. Japan has had to step in with currency market interventions multiple times this year just to slow the slide, at one point spending tens of billions of dollars in a single day. Why is this happening? Japan carries the highest government debt relative to the size of its economy of any major developed nation on Earth, a burden built up over decades. For years, the Bank of Japan kept borrowing costs artificially low to keep that debt serviceable. Raising rates aggressively now to defend the currency would make that debt dramatically more expensive to service, potentially trading a currency problem for a much bigger fiscal one. So Japan is stuck. It can't easily raise rates without risking its own debt load, and it can't hold steady without watching its currency keep eroding. That's the bind driving the headline. Here's why this reaches beyond Japan's borders. Japan is one of the largest foreign holders of U.S. government debt on the planet. A central bank fighting a currency crisis at home has less room to keep buying that debt abroad at the same pace, which matters for how easily the U.S. government finances itself. There's also a mechanical risk worth understanding. For years, large investors have borrowed cheaply in yen and used that money to invest in higher returning assets elsewhere, a strategy known as the carry trade. It works smoothly as long as the yen stays weak and stable. But if the yen were to strengthen sharply and suddenly, those borrowed positions can get unwound fast, forcing sales across other markets to repay loans that just became more expensive. This isn't hypothetical. A sudden yen strengthening move in August of 2024 triggered exactly this kind of rapid global unwind, causing a sharp, sudden sell-off across multiple asset classes within days. A currency sitting at a decades-long weak point isn't just a story about Japan struggling. It's a coiled spring, and if it snaps back, the shockwaves don't stay contained to Tokyo. Quick ask before we move to the next piece of this. If you're trying to make sense of how these global threads connect to your own gold, silver, or savings, hit subscribe, because we're tracking all 3 of these stories as they develop. And I want to know, of the 3 economies we're covering today, Japan, the US, or the Eurozone, which one worries you the most right now? Tell me in the comments. I read every one. Now let's cross the Pacific, because the US had its own rough week too. Section 2. The United States. Growth slows. The Fed splits. While Japan's currency was making headlines, the US government released its second quarter GDP figure, and it came in weaker than expected. The economy grew at a 1.5% annualized rate, down from 2.1% in the first quarter, and below the roughly 2.1% economists had penciled in. That's a real, measurable miss, not a collapse, but a genuine deceleration. It's worth being fair to the data here, because the full picture is more nuanced than the headline number suggests. Consumer spending and business investment actually accelerated during the quarter. Much of the miss traces to a widening trade deficit driven partly by heavy imports tied to AI infrastructure build-out and to a pullback in government spending. So the underlying economy looks somewhat steadier than the top-line number implies. But there's a second piece of this report that's arguably more concerning than the growth miss itself. Inflation reaccelerated. The Fed's preferred headline inflation gauge jumped to 5.1% on an annualized quarterly basis, its strongest quarterly increase since 2022, while the core measure the Fed watches most closely came in at 3.4%. Growth slowing and inflation reaccelerating at the same time is about the least comfortable combination a central bank can face. That discomfort showed up directly in the Federal Reserve's own decision-making. At the end of July, the Fed voted to hold interest rates steady, but the vote wasn't unanimous. It passed 9-3, with 3 regional Fed presidents dissenting in favor of a rate hike instead, worried that waiting too long to address inflation, especially with oil prices elevated from the ongoing Middle East conflict, could force a much more painful response later. A split committee voting the day before a GDP report that showed slowing growth and reaccelerating inflation together is not a comfortable coincidence. It's the same underlying tension, a central bank caught between a cooling economy and inflation that won't fully cooperate, showing up in both the data and the vote count in the same 48 hours. This is the same basic bind Japan is in, just with different numbers attached. Japan can't raise rates without threatening its own debt load. The U.S. Fed is internally divided about whether to hold, cut, or hike because the data itself is sending contradictory signals. 2 different countries, the same underlying tension, a central bank trying to balance growth against inflation without a clean answer available. Section 3. The Eurozone, a quiet third crack. Now for the piece that gets the least attention of the 3, because it wasn't as dramatic as a 40-year currency low or a split Fed vote, but it's part of the same pattern. The Eurozone's Composite Purchasing Managers Index, a widely watched gauge of business activity across manufacturing and services, came in at 50.9 for July, missing the forecast of 51.0 and down from the prior reading. A number just above 50 technically still signals growth, but it's growth that keeps disappointing expectations, and it followed a similar miss the month before. Germany, the bloc's largest economy, showed a slight improvement, but the broader Eurozone figure continues to point to an economy that's barely expanding rather than one showing real momentum. This matters for the same reason the US and Japan stories matter. The European Central Bank, like the Fed and the Bank of Japan, is trying to manage inflation that's been sticky against growth that keeps coming in soft, and persistently weak PMI data narrows its room to maneuver. Add in a recently finalized trade framework between the US and EU that's been read as more favorable to the American side, and you have a Eurozone economy facing external trade pressure on top of already sluggish internal growth. It's a smaller story than the yen or the Fed vote, but it's the same underlying tension playing out in a third major economy inside the same short window. Section 4. Why this pattern matters more than any one headline. Here's the thread connecting all 3 of these stories, and it's the reason I want to cover them together rather than as 3 separate videos. A weak GDP number on its own is just a data point. A weak yen on its own is just a currency move. A soft PMI reading on its own is just one indicator. But when 3 of the world's largest economies each show the same basic strain, growth disappointing while inflation refuses to fully cooperate in the same short window, that's not 3 unrelated local stories. It's a pattern, and patterns tend to reflect something more structural than any single data release can capture on its own. Elevated government debt loads across multiple major economies, central banks that have less room to maneuver than they did a decade ago, and a global trade environment that's become more fragmented and less predictable. This is exactly the kind of environment where gold and silver have historically attracted attention, not because of any single dramatic event, but because they don't depend on any one government's currency, debt position, or central bank decision. And you can see that reflected in how institutional money has actually been behaving. In the second quarter of this year, gold ETFs, the funds ordinary retail investors use to get exposure to gold, actually shed roughly 45 tons as retail sentiment cooled. Central banks, over that same quarter, added roughly 289 tons, more than 6 times as much, according to World Gold Council data, the largest quarterly total on record. That's not a coincidence, sitting next to 3 major economies showing strain in the same stretch. Central banks aren't trading around a single week's headlines. They're positioning around the multi-year picture, debt levels that keep climbing, currencies under genuine pressure, and central banks with narrowing options. Exactly the pattern we just walked through in Japan, the US, and the Eurozone. Section 5. The honest caveat. I want to be careful here because it would be easy to take 3 data points and turn them into a story bigger than the evidence actually supports. None of this means a dramatic crisis is imminent in any of these 3 economies. The US GDP miss came with a genuinely resilient core. Consumer spending and business investment both accelerated. The Eurozone number, at 50.9, still technically signals expansion, just a weak one. And Japan's situation, while serious, is one policymakers are actively managing through intervention rather than ignoring. Anyone telling you these 3 data points guarantee a specific outcome, a currency collapse, a recession, a metals price target, isn't being straight with you. What these 3 stories genuinely show is that the assumption many people carry, that major economies and currencies are simply stable background facts that don't require much thought, is being tested simultaneously in multiple places right now in a way that hasn't happened quite this visibly in some time. That's worth understanding clearly. It's not, on its own, a reason to panic. Here's what I want you to walk away with. Japan's currency didn't hit a 40-year low because of some isolated Japanese problem. The US GDP miss and the Fed's split vote didn't happen because of some isolated American problem. The Eurozone's soft PMI data isn't just a European story. All 3 are downstream of the same basic tension: government debt loads that have grown faster than the economies underneath them, and central banks that no longer have clean, comfortable options for managing growth and inflation at the same time. That tension showed up in 3 different countries, in 3 different kinds of data, inside roughly the same week, and central banks around the world have been responding to exactly that kind of environment by buying gold at a record pace, even as everyday retail investors have been pulling back. I want to hear from you. Which of these 3 stories, Japan's currency, the US Fed split, or the Eurozone slowdown, do you think matters most for where gold and silver go from here? Tell me why in the comments. I read every one, and it shapes what we dig into next. If this connected some dots for you that felt like scattered headlines before, subscribe before you go, because we'll be tracking all 3 of these threads as they develop, along with what it means for your gold and your silver.